Thank you guys so much for taking the time to review our presentation. This is our restructuring pitch on Altice. So, my name is Francis. I'm a sophomore studying math and economics with a minor in stats and data science here at UCLA, and I was born and raised in Northern California.
My name's Bridge. I'm a sophomore as well at UCLA studying math economics and minoring in accounting, and I grew up in Hong Kong. To look at our presentation as a whole, we'll be going through the overview of the company, Altice USA, kind of what's going on with it, its debt profile, its business strategy, and then we're going to go into evaluation in terms of DCF, public comps, present transactions, waterfall analysis, and then we're going to go into a preliminary strategy to look at what we can do to help this company restructure or just improve in its business strategy overall. So Altice USA is a broadband, video, mobile, and advertising service provider that offers connectivity and entertainment solutions to both commercial and business enterprise customers across the US. Altice operates under the Optimum brand and serves almost 5 million customers across almost half of the US. Its main business operations are video services, telephone services, mobile, enterprise, which is, large businesses and news. So in terms of its stock market performance, in the last 12 months, it's down 18.2%, has a market cap of $927 million. And its profit is doing really poorly, has a profit margin of negative 21%, and its total debt is sitting at a whopping 26.49 billion. So when we look at, the residential revenue breakdown, which is actually somewhat similar to its business revenue breakdown, we can see that a large majority of it comes from broadband and video revenue. And as you can see on the top right side, the financial performance, it's been steadily declining for the past 3 to 4 years.
And just like he mentioned, this steady decline is really the reason that we see its shares down to $2 per share, down from all-time highs near $40 a share. So it's been going through a lot of struggle over the last 5 years.
So in terms of the overall debt situation, we can see that Altice suffers from high leverage and really high debt service. As of fiscal year 2024, its total indebtedness was almost 25 billion, making debt service pretty much the biggest hamper of its cash flow and flexibility. To add insult to injury, Altice USA has demonstrated really poor performance with continuously declining operating income and really, really high capital spending. And we can see that as a high interest burden. Its net interest expense was 872 million in the first half of this year, which is a whopping figure for a company of this size. So, in terms of competition and technological pressure, Altice USA is also losing out to larger players within this space. It has ongoing subscriber losses and intense capital investment, as we can see, is required to keep pace with its rivals, but its profits are not matching. So, in terms of its liquidity profile, we can see that it has a total liquidity in terms of to pay off debt of about 750 million, and it has a fixed charge to coverage ratio of only 0.6 times, which is incredibly weak compared to its peers. Its leverage is also incredibly high. Its leverage is at about 7.8 times, which is almost double of its peers, Charter at 4 times and Comcast at 3.5 times. And the main issue regarding Altice USA is that it faces a maturity wall in 2027 to 2028, with about half of its debt due then, $12.7 billion. And should Altice not find a way to refinance or generate more cash, this will likely be the pitfall of the business. So here's a summary of the debt in terms of how it's built and what it's made up of. As we can see, there's a lot of senior guaranteed notes, a lot of senior notes. And in terms of the value of its fixed rate debt, we can see that it's trading at 74 cents on the dollar at a 26% discount, signaling distressed expectations amongst debt investors. And given that it faces a substantial debt maturity wall in the next, about 2 to 3 years, it indicates that Altice really has to restructure immediately.
Yeah, so we've already touched on the fact that they're having a maturity wall in the next couple of years and that they're already at an incredibly high amount of leverage. So you might be wondering what the plan is to turn around their declining operational performance and be able to pay off some of these loans in order to delever themselves and put themselves in a better place for future growth. So we came up with two main strategies. So the first, in the short term, is going to be to first of all divest away from their telephone industry, which is making up 3% of their revenue, but about 10% of their operating expenses. So if they're able to sell that in the next couple of years to a major player like Charter, like Comcast, they would be able to improve margins and generate more operational income, which would help flow through to free cash flow that they could use for debt paydown. And secondly, and this is a little bit more of a longer term of the short term options, is to divest away from their mobile division. So their mobile division is the fastest growing business segment, growing at 35% compound annual per year. And it's looking at grow about 40% over the next 5 years. It is seeing a lot of investment across the entire space. And if Altus USA is able to continue investing in this mobile division, continue growing it at 30 to 40% per year, and then selling it in 5 to 7 years at a multiple alongside industry average, they would be able to generate about $2.5 billion to be used for debt paydown. Now, this is going to come after their maturity wall, but as we'll show a little bit later, the operational improvements from selling the telephone industry quickly or the telephone segment quickly, as well as paying down debt with additional EBITDA, is going to decrease their leverage by enough that they should be able to refinance a lot of this debt that's coming due with more favorable debt that then they can then pay off when they sell their mobile division. And then longer term, we want to see them accelerate their broadband expansion and rebuild their business and focus really on the broadband sector, which is seeing the lowest churn rates and highest average revenue per user out of broadband in the last 5 to 10 years. So, especially with data centers and the need for high, fast-paced, kind of connected fiber optic networks, we see their broadband industry helping expand EBITDA margins by about 2% per year into the long-term future and increasing revenue per user by 2 to 5% due to upselling. And we think this is their should be the core of their business going forward in longer term. So this is our valuation summary that we generated. We used a range of different methods from multiples across Preston transactions and a DCF. And we were able to generate an implied valuation range that was between 26.2 and $31 billion dollars. And we settled on an implied enterprise value of about $28.7 billion dollars. This is factoring in for the fact that they're going to be paying down debt with additional EBITDA. This is factoring in the divestitures that they're going to be completing. This is factoring in the expansion of broadband. So this does make a lot of lofty assumptions, but as we can see, according to our valuation and our calculations, if they're able to implement all the strategies that we have kind of put forth, they should be able to get their head out from underwater and have an enterprise value that leads to them having a little bit more equity than they currently have and actually trading above par right now where they're trading at 74 cents on the dollar, I believe. So yeah, this is just a quick breakdown of the public comparables that we ran. We ran them against a lot of major competitors like Comcast, Charter, Cable One, Lumen, Frontier, a lot of which have a lot lower leverage and thus a lot more favorable multiples. So in general, we applied the 25th percentile multiple to Altice USA when we were valuing them. And these are just a couple of precedent transactions that we thought were important. So we looked at precedent transactions not only in valuing the overall parent company, but also for the divestitures, just to get an idea of what the median multiple in the space was. A notable transaction on here is the Cox Charter transaction. It was a $34.5 billion deal. So it was a super massive deal. And it was the first major deal in the industry in the last couple of years, as we see a lot of these deals are 2021, 2022, 123, 124. So we've actually seen kind of limited deal making in the last couple of years in the space, but this massive deal by Charter and Cox might be signaling the start to a more of an expansionary period in M&A flow within telecom industry as a whole. And then this is our just income statement with a couple of key assumptions and qualitative rationale here. We see that broadband is going to be stable with growing revenue per user, low churn, and a major driver of capital expenditures, which we did model out separately. See the telephone is going to have like a pop in demand right now as we see. There's actually a push with AI voice implementation for telephone industry, telephone businesses, and it will improve margins considering it makes up 3% revenue, 10% operating expenses. And in general, on the left, that's just some key rationale that drove our assumptions overall. Let's see. It looks like our models got a little bit unformatted here. In our PDF, you should be able to see these a little bit more clearly, but this is just going to be, another another model that we built out here. I believe this might be the CapEx schedule or the debt paydown schedule. And here we have, yeah, so our charts got completely messed up right now in presenting, so I really apologize for that. But this right here is a little bit of a waterfall analysis. So on the top, you'll see our debt paydown schedule. I don't know if you can really clearly make it out or if that's just on my screen, but we see the income from divestitures coming here in 2026 from the telephone industry, in 2032 from the mobile industry. That really help pay down debt. We see that additional EBITDA from margin expansion, focusing on broadband. And as we see, we look for a difference between 2025 and 2036. Equity is about doubling as the leverage ratio and interest coverage ratio come closer to converging there at more healthy rates.
So here's our liquidation valuation, kind of what would happen if we were just to sell all the assets of the company. So as we can see, we could expect to recover about 50% to 60% of the company's assets. So somewhere between the range of 4.5 to 6.3 billion dollars. So now we're going to go into the preliminary strategy.
Yeah, so I mean, I can start with this one. So as we see on the left is the divestment of the telephone and mobile sectors, like we've touched on. It's been a kind of a common theme throughout. If Altice wants to make it out and become a successful company, they need to specialize, and we think they should specialize on broadband. So that leaves an opportunity to improve margins by getting rid of underperforming units like their telephone unit, which is shrinking year over year, and also capitalize on overperforming units like the mobile industry. So these are kind of a tale of two different stories with the telephone industry or telephone unit sector, I guess. It makes up 3% of revenue and 10% of operating expense, which I've repeated many, many times because I think it's really important. If you sell that business unit, you're automatically improving margins immediately, effective 2026 or 2027 or whenever you do sell it, which is really going to help them grow forward and generate more EBITDA for pay down. And with the mobile industry, it's growing at such a high rate that you're going to be able to sell it for a premium in the future and get a massive price tag. Like we saw, 2.5 billion is what we modeled for. Could be more, could be less, depending on the multiple paid, especially for something growing at 35+% annually. So we see this as a really good idea as far as directing the proceeds towards debt reduction and kind of stabilizing liquidity of the company to improve margins and focus on specializing in broadband going forward.
So, as previously mentioned, in terms of a Chapter 7 liquidation situation, we would estimate 4.5 billion to 6.3 billion dollars with 50 to 60% recovery for secured creditors. However, there would be no recovery for unsecured creditors and equity holders who would receive no proceeds. And overall, when this happens, Altice USA would seize all of its US operations. Chapter 7 liquidation is not really ideal. It kind of represents the floor scenario, the value destructive scenario, and the worst case scenario. And it thus reinforces the need for potentially either a strategic divestiture or a debt equity exchange. So, in terms of the debt equity exchange, which is most likely the most short-term feasible idea, it would involve a consensual debt for equity swap within Altice USA, which reduces interest expense, improves short-term free cash flow, and lowers credit risk. And since the debt is trading at 74 cents on the dollar and it has wide spreads, this signals potential creditor willingness to negotiate for debt equity exchanges. And such an exchange would elevate the position of secured creditors to sort of a more defensible and recovery level, while also preserving Altice USA's valuation, operations, and overall health of the company.
Yeah, so that being said, just to wrap it up, we really think that there's three main strategies that Altice could go for. So the first would be the divestitures, the second would be worst case, a liquidation scenario, and the third would be like the short term stopgap, I guess. So this is kind of broken down into like a base case, a bear case, and a bull case. With the bull case being divesting and specializing and really seeing future growth, doubling equity in 10 years, just for clarification. And just lastly, this is kind of our DCF, this is our sensitivity table, appendix, how we calculated terminal value, everything like that for Altice USA.
Thank you very much.
Thank you guys.